Okay, I think we'll get started. A few housekeeping things. My name's Chuck Ewing with JLL. Our Office of Risk Management panel will be exiting here. We're going to do the panel combined in the interest of time to try to get done by 3:15. We'll still get done, I think, by 3:15. I know your program says 3:30, so we'll see how the Q&A goes. Our panelists need to leave for a discussion with the commissioner, I guess, at 3 o'clock. So pardon a little dislocation here, but it is necessary. So first of all, we'll get started with the Office of Risk Management panel. I'll introduce each member for you. This is Keith Becker. Keith is the Deputy Assistant Secretary and Chief Risk Officer of the Office of Risk Management and Regulatory Affairs. Keith is going to be covering an overview of ORM. He's going to take the veil and lift it up for us a little bit. We're obviously in the multifamily side. We don't see how the department operates. It's a separate department, so this will be a terrific, I think, background for us to understand exactly how they approach their responsibilities. And to my left is Eileen Lyons. Eileen is Associate Deputy Assistant Secretary in the Office of Risk Management. Eileen's going to give us a little bit more of the portfolio performance and talk, I think, a little bit about collaboration with lenders and some of the things that she would like to hear, the department would like to hear from us, probably indicate that through multifamily, not directly with ORM, but hear a little bit about what is going on out there in the marketplace. And then we have Liz Artiega. I think all of us know Liz well in the multifamily side with her efforts within affordable housing. She is now Director in the Office of Risk Management. And also we have Zach Scotchko to my left. Zach is a Senior Production Specialist, Technical Support Division in DC. Both Liz and Zach are going to provide an overview of the functions of the department regarding multifamily, and they'll talk a little bit about their involvement with National Loan Committee and concentration of risk review. The mystery man over here, Stephen Sprecher, Stephen's going to help me with the Opportunity Zone presentation, which we'll cover in about 20 minutes or so. So, Keith, you want to start us off?
Sure, thanks. Thanks, Chuck, and thanks to the Eastern Lending Association for making room for us on the agenda. Pleased to be here and pleased to be able to have a brief conversation with you about risk management and regulatory affairs. The regulatory affairs piece is not working? No? Good? Okay, sorry, thank you. So the regulatory affairs piece is a group that I have which is related to manufactured housing. I also have manufactured housing regulations and standards under my guidance, and so that's the regulatory affairs piece. We're here to talk about risk management, and specifically risk management as it relates to multifamily housing. So pleased to be able to do that. I've been with HUD since November of 2018. I worked 26 years for Freddie Mac in several different areas, mainly single family, but some commercial and some enterprise risk there. But a whole career in lending, residential and commercial lending, and some ADC way early in my career. As I said, been there since 2018. The purpose of risk management really is, as the banks would know, a traditional three-line of defense structure. First line of defense is the multifamily business area. They call them a program office. I call them a business area. Multifamily is fully responsible and accountable for the risks that they take, the risks that they expose HUD to. Our role is primarily in the second line with a bit of a hybrid twist in that the program offices at HUD don't have as well built out risk groups as some of the banks would and as the GSEs would, and so we provide some of the frontline function, but mainly second line function risk and risk oversight for, in this case, for multifamily. I also have responsibilities for the healthcare business and for the single-family business. And I've got an operational risk group and model governance and model risk group and kind of shared services responsibilities. So back to multifamily, again, they're the first line of defense. They've got all the delegated authority, and they're responsible for sourcing, processing, underwriting the business as it comes in, knowing their customers, understanding the risk, and being able to document and express that in a transparent way to us and to the leadership in certain situations. And it is important to us that the relationship between us and multifamily, in this case, be collaborative, transparent, good dialogue, so that we can provide effective challenge and oversight, and also input to certain key decisions, certain credit policy decisions, credit policy exceptions, and in some cases, we have some direct signature authority for larger and riskier deals as they come through. And so we have a role there as well. And for that to work effectively and seamlessly, which is our goal, doesn't always work that way, but it is our goal to be effective and seamless in what we do. We need to have a good dialogue and a good relationship with the business. So that's what we're striving for. That's what we're building toward. Before I get into more of the specifics, just back up a little bit. The office itself was chartered in 2013 by Congress. Coming out of the financial crisis and HERA and Dodd-Frank and all those other bills, laws, and regulations, they mandated that HUD establish an Office of Risk Management that was independent of the businesses and to perform in the traditional, second line of defense as part of a three-line defense structure. And so, again, multifamily first line, where second line, audit would be the third line. In our case, it's largely the IG. And we try to fulfill those responsibilities, and we've staffed up to be able to do that. So roles and responsibilities, it's a whole lot of things. We've got post-close loan reviews, where we should be spending most of our time is in post-close loan reviews. Did multifamily follow policies and procedures? Are their decisions well supported and documented, transparent? Are they within the risk appetite? Do they know their customers? Do they understand the counterparties? Do we have effective surveillance for managing our counterparty risk? Do we have effective asset management functions? Do we have an effective watch list function? Are we processing our claims to the extent that we have any promptly and efficiently? That's kind of normal blocking and tackling that I think you would expect a risk group to be able to do. And that includes reporting and data analytics, and I think Eileen's going to talk a little bit about that. Geo risk, other kind of market risks, do we understand them, and are we providing effective challenge? Because as much as we can identify and analyze this for ourselves, part of it is kind of working with multifamily in the business areas to make sure that they understand and identify it and consider it as part of their frontline work. And for us to have a reasonable conversation, either as part of the normal day-to-day work and as part of our credit committee meetings, is to have those types of conversations too. We also have responsibility for a risk appetite that we're working on. We don't have a firm risk appetite established. And it's something that I'd like to get done this year yet if we can, so that we have a better way of expressing to leadership types of risk we're going to expose the HUD to, the FHA, and they can have a better expectation of what types of assets we'd be underwriting and insuring. Operational risk, I mentioned that earlier, and I have a separate operational risk group. But that, as it relates to the business, their ability to execute efficiently and timely, whether they're correctly considering the impact of external events. Coronavirus come to mind. Certainly something out there that everybody's thinking about and trying to figure out how it is impacting our business and how it might impact our business should we have to do certain things like more teleworking and things of that nature. People and culture, do we have a handle on whether we have enough people? Do we have enough competent people? Is the culture a healthy culture and one of the businesses and the people in the businesses working effectively with management. And again, not only do we provide effective challenge, but they should be providing effective challenge in terms of the work that they're doing too. Credit risk oversight, policies, policy evaluation, policy exception evaluation, again, feedback to the business on certain policies under consideration. And then again, as deals are working through and to the extent that there's a policy exception, have we properly evaluated that and does it fit within our appetite to do something like that? Model risk is another area that we have spent a great deal of time with and have a separate Office of Evaluation under Liz as it relates to commercial mortgage. That's responsible for our default models, ensuring that our default models are up to date, current, are incorporating industry best practice, has appropriate training data, updated in it as necessary to make sure that it's current in its forecasting of risk. All of that feeds into our capital framework. And so for multifamily, it's the GISRI fund, but is the fund healthy, and do we have a good understanding of how the fund will behave in the expected path and in certain stress paths? Do we have a good idea of whether there's adequate claims paying capabilities and our ability to express that both to leadership, to the commissioner, to the secretary, and to members of Congress, should they ask, is also a role that we play. In that part of the business, we model the budgetary impact of key policy changes, forecast impact of the budget based on anticipated volume, to the extent that, and I keep hearing here and in our single-family space too, volume is pipelines are full, volume is picking up. Have we properly forecasted that? And if we haven't, we'll have to go back and do some updated forecasting to make sure that we've got sufficient allocation of capital toward that volume. Watch list asset management oversight might be a bit of a surprise to Chuck and those guys, but we're working hard to try and develop a stronger watch list asset management function that we'd like to be able to work with the business on, so that we both have a kind of an agreement of what troubled assets or what assets that are riskier that we want to look at, and make sure that we are not only monitoring but making sure that we are transparent with management, with the leadership in terms of what assets might be under stress, what actions we might be taking to have increased surveillance or increased due diligence with those assets. And give them a sense that we have got our eye on the ball, and that again, the idea here would be to minimize the degree of surprise that kind of a loan going under stress might present to management. I think the worst thing we can do is wake up and find the headline in the paper that some asset of ours is all of a sudden under stress or is in danger of defaulting, and we had no idea, or more likely management had no idea. Because when those happen in our space, some congressional aide or some congressperson is quickly checking up to see what our reaction to that might be in their district. As somebody outside the district is wondering whether we know what we're doing and are we protecting taxpayer funds adequately. So we got both sides of that one, and we spent a lot of time working in that space and thinking about it. We're also interested in market intelligence, and I look at that as an area for us to collaborate closely with the program office, with the business area. And then industry best practices. Are we evaluating our risk and aware of industry best practices and doing so, and making sure that what we're doing is consistent with that and comparable in terms of how the GSEs might look at risk and how some of the other banking institutions would look at risk. I think it's important for us to make sure that we understand the risk the same way. And with that, I might pause and hand the mic back to Chuck and see if we can go right to Eileen.
Can we go right? Are there any questions?
Yep.
Or, okay. Pull out my notes. Hey, hi, everybody. Thanks again for the invitation. Can everybody hear me? Appreciate it. Great to be here in Baltimore despite the coronavirus. We made it down from Washington, so. Sorry. I'm here with a fellow Maryland person. I'm from Virginia, so. But Bob Iber's right here in the front row from Baltimore, so I should know my directions. Again, really happy to be here. As most of you know, I joined FHA back in May of 2018, and I spent a year, a little bit more than a year, working in the front office with Bob Iber and Lamar Seats. And it was a great year, and we had a lot of fun, and I learned a lot. So that's did a lot of business with HUD back in the old days, a long time ago, but it was nice to refresh and get to know everybody and really understand the multifamily department and how it's grown since I did work years ago. Joined the Office of Risk last June, and again, the experience I had in multifamily really was valuable for me and a benefit to my new role, which is trying to figure out where the risks lie. And great, I work with Keith back at Freddie Mac, so we have I'm very interested and very informed on the 3 lines of defense program. I worked on that when we did it at Freddie Mac, and I think it's really a great tool to use. So again, just I don't want to reiterate what Keith said, but we are second line of defense. So we are not, the accountability is held within the program office. And again, we look to Zach and to Pat Burke and to Lamar and Bob for the front office. Again, that's where the accountability is. As Keith, I'm sorry, lost my talking points. So risk primary function is to manage the risk in the portfolio, as Keith said earlier. So again, to protect the mortgage insurance fund, which is the GISRI fund, and we manage to that. So again, we don't, have the American taxpayers at the end of the day is what we're looking out for in the fund. What we're monitoring in the book is both quantitative and qualitative. So again, we look to portfolio risk. We're looking at claim, as Keith mentioned, claim and default rates, vacancy rates. We're looking at trends to see where everything, is going, in which direction. The geographical market risk is something that's very important right now. We're looking at, again, it comes from the commissioner, has asked us to, look into that. So we've been working a lot with a lot of the folks in the room on where you're seeing any issues. Again, a week ago, if I had talked about this, I probably wouldn't have even brought it up. We have coronavirus now, so we're looking at that as, to forecast it and try to figure it out, which I know everybody in this room is doing. We look at counterparty risk, as Keith said, and, interest rate risk, which way is it going? It's going down lately, so we're, again, trying to figure it out and to forecast it. The other thing that I just want to mention, Chuck had asked me to just give you a quick overview of the current book of business. So my statistics are as of the end of January 2020. There's currently the multifamily insurance fund is, or we're insure $103 billion insurance in force. There's approximately 11,600 loans. Again, these are just the insured loans, not the non-insured loans that we also monitor. The default rate is very good, and it's historically low, and it's 0.06%. And lastly, our claim rate, again, is very low, and it's historically low. It's 0.008%. So right now, pre-coronavirus, everything's been really good. And as Commissioner asked us a couple of weeks ago what we're looking at, and it's sunny skies. Of course, had to change a deck that we prepared for him for next week, credit committee meeting. We got a couple of clouds out there, and it's you never know what's going to happen. It's overnight things can change, as we've all just seen. So we're all looking at that. That's basically it.
Thank you. Liz, you want to, and Zach, you want to discuss a little bit about roles with National Loan Committee and concentration of risk review?
Hello, everybody. So I just wanted to mention real quick, just a quick overview of the Office of Risk Management. We do have two divisions within our office. We have the Credit Risk Analysis Division, and then we have the Portfolio Analysis Division. So where we interact with you the most will be under our Credit Risk Analysis Division. Some of our goals or objectives under this division are to make sure that previously approved and implemented policies are complied with, and that new policies and loan decisions will not compromise the insurance fund. And you've heard Keith and Eileen both speak to that. So where we interact with y'all quite a bit, and with the Office of Production directly, is that we do have a responsibility to assess the impact that any new policies will have on the insurance fund. So we were involved in this 3-year rule elimination that, from what we hear, y'all are very happy with. So we had a little bit of part, we had a little part in that, but we don't actually write policies or anything like that, but we will look at them, review them, make sure that they are safe, again, so that we do protect that insurance fund. We're looking at the MAP guide as well. Where I started over in the LIHTC pilot program, Office of Risk, I remember them reviewing that policy as well, and I kept wondering, why are they asking so many questions, They need to, stop it. This is a perfectly safe program, but now, of course, on this end, I do understand that we just have to make sure that the policies do make sense, and, any notices or mortgagee letters or guidance that's issued, again, is in the best interest of the department. We do review certain loans and borrowers whose exposure level is higher than normal, and we'll get into that in a little bit. And we do monitor, again, the state of the portfolio, so we definitely want to stay on top of default and claim rates. Based on the information that we have in our internal systems, and again, this includes historical information and loan performance projections, and information that we have from working with the Office of Multifamily Housing, we do serve as a voting member on the National Loan Committee. This is for loans that are over $75 million, or in the case of a co-op, a loan that's over $50 million. We haven't seen very many in a while, and actually since I've been there, I haven't had the opportunity to serve as a voting member. Again, we just don't see that many large loans come through. And y'all would know better than I do as to why we're not seeing that many, but again, that's something that's an area where we would get involved. So in this sense, we have to make sure that we fully understand policies and guidance issued by multifamily production. I do want to thank Terry Wellman and Ed Fallon, who will be serving on your behalf as the heads of a working group. So they'll be working with us and helping us understand, market conditions and other areas that might affect, how business is done, or anything that may have an impact on our business levels. So again, we're very fortunate and thankful that both Terry and Ed have agreed to or offered to work with us. As we all know, they do a lot of work for the Office of Multifamily Production, and so again, we're happy to have them working with us as well. Concentrated risk reviews. So Zach, just if you want to offer anything, we do perform reviews in accordance with the 2 housing notices that are currently out. That's Housing Notice H 2018-09 and H 2013-07. We do get involved where a borrower wants to come in with an unpaid balance of $800 million or over. So this is a joint review between production and MACOD, with decision and approval jointly approved by Lamar and Keith. So we do work together on that end. If it's anything, or if we have a borrower with an unpaid balance of $1.2 billion and over, again, it's a joint review between production, MACOD, and the Office of Risk Management, with decision and approval authority reserved to the FHA Commissioner. So we do strive to work closely with Zach and with David and with Tom to make sure that we're looking at your borrowers closely, and fairly, of course. and that we are asking the right questions, and that we are making sure that they are an acceptable risk to the portfolio. So it's not a decision that's made independently. We do work together, and we should be asking each other, questions throughout the entire review process. We do not get involved in any review until the Office of Multifamily Production reaches out to us. So we do work through the Office of Multifamily Housing. We should not be working directly with y'all, but of course we can relay information back and forth, and that proper channel would be through the Office of Multifamily Production. Over the last 2 years, we've reviewed about 5 different large borrowers in multifamily. I don't know, Zach, correct me if I'm wrong, but I think those are 5 that were at 1.2 billion or over the last 2 years. So Zach definitely does a lot more reviews as far as the concentrated risk reviews go. And again, so it's just with 800 million and over, that's where we would get involved.
My name is Zach Scotchko. I'm kind of the counterbalance to the risk panel here. So as you heard from Keith and Eileen and Liz, they work in the second line of defense. I work in the first line of defense. So I work in Multifamily Production Headquarters Technical Support Division. We are the group that is coordinating with all the field offices and the industry through the drafting table to rewrite the map guide. It's a small group of 6 people. David Wilderman is the director. So we do all the map guide updates. We do many of the production-related housing notices. We decide appeals that come out of decisions coming from regional offices, and we are the staff people that actually do the concentrated risk reviews for large borrowers. And currently, those are the borrowers that are over $500 million. So, as I said, I actually work in the first line, whereas my colleagues here primarily work in the second line. But, one of my goals here is to kind of show how there's collaboration between the 2 offices. For instance, with a prior credit review that's going to be over 800 million, I'm going to share that very confidential submission package with risk early on so they can conduct any independent review. I'm also going to provide our recommendation memo that goes out for signature and answer any questions and defend or support any conclusions that we have. In terms of policies, again, a kind of illustration as a first line, second line. We're going through a large clearance process right now with the map guide. There's there's a final clearance process, and so a lot of these significant map guide policies that are changing, Office of Production is submitting those to the Office of Risk Management Regulatory Affairs so they can perform this independent check, such as Keith mentioned, is there budgetary impact? Is this going to change model assumptions? Is this going to have some sort of unexpected effect so that we can all be congruent in the end? And so that's I wanted to be able to illustrate what the first line, second line really means, and also let you all know, as most of your map lenders, that your point of contact is with multifamily production and that first line of defense.
Okay, it's 3 o'clock. I don't want you guys to be tardy.
If there's Q&A,
Yeah.
we're happy to take if anybody has any questions.
Oh, great. So any questions?
We really don't want to get back to the office and have to deal with the coronavirus, so.
Actually, I have one question, and this came from personal experience. I had a loan a couple of years ago that came in at $74,999,995,000. What is your role in there? I mean, it's just under your limit, but I was always curious.
I mean, so technically it is 75 million, and that's where we prefer to step in. I mean, we don't want to keep making close calls, and I think multifamily production understands too that it's 75 million. That's what we all agreed to, and so that's what we're going to go with. I haven't seen them that close though, really. So, okay. Okay, but
I will say if the Office of Risk is functioning properly, and I'll give you a chance in a minute, our role should be relatively seamless or transparent to you. You shouldn't hear a lot from us. The real voice, the real voice of HUD, and we are collaborating with multifamily, but it's really their voice, it's their decision. We tell them what our feelings are when it rises to our level. You know, we haven't always clicked on all cylinders, and so I think sometimes these deals that come in just under 75 million, maybe it's a little bit of the lender understanding that we haven't always clicked well, but we have I think made great improvements to our process since I've been here. And I think the team that we built is very strong. Liz has done a great job coming in and kind of setting things up. Our quantitative group is stronger, and so I'm cautiously optimistic that we've kind of put some of those hiccups behind us. But again, in good times, you should never hear from us. We should be working behind the scenes with multifamily. The deals that come in, we get an early look at them. We're responsible for spending the right time on them early on and giving them preliminary feedback back so that it can come back to the lender. And I think the worst thing that can happen is the thing has been worked on within multifamily. They've more or less done their work. They've gotten to what they think a recommendation is. Then it comes to us. Then we have new questions. Then it's got to go back to the lender, and it's inefficient. It's a time hog. I think that's the worst thing that can happen. And so that's one of the things we're working on is to try and eliminate those incidences in the past.
Can you hear me? We did one of those 74,999 deals last year. And the reason why that might happen sometimes is because it's a circular thing. So the second you go $1 over, it automatically takes your loan below 75 million. So that's the highest loan you can possibly get in some scenarios because it triggers the loan to value constraints and whatever. It drops your loan
Right,
down
the
to
whole criteria changes.
Correct,
Right.
the criterion changes. So it's a circular thing. So that's the highest you can possibly make your loan. It's not to avoid any, fear of the deal being bad or anything like that, typically, at least for ours.
That's why we have Zach, because he told us that when I first joined. So he's like, no, there's a reason why. So that was very helpful. And again, we have a great partnership with Zach and the multifamily program. And, hopefully everything gets, runs smoothly. And we're one HUD, to quote Keith and Lamar. So.
This is similarly, and this is kind of enlightening for HUD field staff who don't interact with you a whole lot. But given that scenario at 74,999, and then they rate lock, and that goes above the threshold, how would we deal with that? This is something I should probably talk to you on offline, but I'm just curious because there are,
well, can I?
Sure.
I mean, if the firm commitment's already been issued, there really isn't a way for us to then weigh in and make any type of decision at that point. But it's something that we could monitor, over time. Maybe do a loan review, or if that was necessary. But if it's already, the firm's issued, it's rate locked. It's a little too late for us to then jump in and, try to make a decision.
And then we always get an opportunity in loan review after the fact to look at those, and that can be part of the sample criteria is to look at loans right at that spot. And if we think things are going well, no need to do anything other than make it part of loan review. And if we think that we should have a conversation with multifamily about engaging more on those types of loans, then that's what we would do.
Any other questions? All right, well, thank you very much. Really appreciate you being here. We're going to jump right to opportunity zones. I'm going to, Eileen, did you have anything that you can pass on to me? Eileen was kind enough to give me some national information on the opportunity zones.
Real quick, Chuck, that came from Ken, so I appreciate his giving me the most up-to-date. Because the
Excellent.
information I had was as of the end of the month, so
Excellent, excellent. So as far as, this is interesting, because we've been, as lenders, we've been very interested to see what kind of volume we would see. And so as far as D4 new construction, there's been 14 deals involving opportunity zones totaling $585 million. There's been 8 D4 sub-rehab deals totaling $142 million, and 20 223Fs totaling $339 million, for a total of $1,068 million. That's meaningful. 42 deals. I'm sure there's and we'll talk about this, a wide variety of deal terms within that, but that's good stuff. I'm sure the department's pleased with those numbers. I know that Eileen mentioned that to me. So with that, I'd like to ask Stephen to go through the HUD notice that created some of the benefits with processing a HUD loan that's in an Opportunity Zone fund, some experiences and processes he could share with us regarding the Northeast region, and any insights he may have with underwriting processes. So, Stephen?
Good afternoon. Everybody may be familiar with Notice 2019-07. It was issued last May about the opportunity zones, and it officially designated reduced application fees specifically. Normally, the application fees are $3 per thousand. They were reduced to $1 per thousand of loan amount for broadly affordable, $2 per thousand for affordable and market green projects. And this was a result of the, I believe it was the 2017 Tax Cut Act. And this was finally the implementation of it. The Secretary of the Treasury designated various opportunity zones throughout the nation. There were mainly something like 8,700 census tracts. Each governor in each state can designate what these tracts are. So, and some of them are in zones that really need investment. Some of them have little tabs that stick out in already nice areas that don't necessarily need them, but that's the way the census tracts are drawn. Originally, the act came out noting it was just to encourage public and private investments in urban and economically distressed areas, including qualified opportunity zones. And originally, specific HUD underwriters were supposed to be working on this in each region. Well, that didn't work out in reality because we have specific geographic knowledge in our office that another office doesn't have. So it's sort of done on a geographic basis. It's always a senior underwriter that does these, but it doesn't make sense for someone in the Baltimore office to do a deal in Massachusetts and vice versa for someone in Boston to do Virginia deals. So it also noted that these were to be expedited. We try to expedite everything these days. We really try to keep to our deadlines. And what you folks can do, especially for us to keep to those deadlines, is have a completed application. And I can't stress that enough, with everything done ahead of time. Some things are discovered during underwriting, that happens. But we really do try to stick to the 60 days for the D4s and the 45s for the Fs. Don't always make it because we have to take them out of processing due to some items that come up. Often there are, as you know, Davis-Bacon issues are popping up all over the place, and other issues. But essentially, we process these just the way we would a normal deal. It's with an appraiser, an environmental analyst, and a construction analyst for the D4s, the single underwriter model for the Fs. As an underwriter, I visit both my D4 projects and my Fs. I visit the site and do all the comps. A lot of underwriters don't do that. They let the appraiser go out and visit. I feel that I just have to see the project. The project that Ken is probably going to talk about is one that is very high public purpose, 11 Parkside. You're going to go through the details of that. And I got a hold of Ken Dureski's slide, which you have some information on. Out of the 42 deals so far, 55% have been either broadly affordable or affordable, and 19 have been green or market. 11 Parkside was one done by someone else in my office. He wasn't able to make it here today. But my two Opportunity Zone deals, one was on the Norfolk waterfront, gorgeous property. It was an acquisition. Perhaps 10 years ago it needed incentives. But again, it was just this little tag of a census tract that was left over. And then the other one was in Blacksburg, Virginia, near the airport, that already had a lot of development. So, but Ken's is a perfect example of how complex they can be. So he'll go over that project.
Let me I have a few slides here. So, first of all, as far as I think the last time that I presented an Opportunity Zone deal was at the Midwest Lenders Conference back in August of last year. And I don't think we were getting a lot of touches with Opportunity Zone deals. This was one of the first ones that JLL has done, and I know in talking with many other lenders that I stay in touch with, some were seeing mixed volume with them. Since then, I think we've all seen more deals. They've all varied quite a bit. The kind of deals that JLL has seen parallel what this case study is. We've seen two deals like that, and we are looking at many others. But this deal in particular would not have happened without the Opportunity Zone funds. No doubt in my mind. This deal goes back to 2017, a pre-app. It was a pretty straightforward deal out of DC. It was a pre-app invitation that we received, and then the sponsor updated the construction cost, saw the financing gap, and decided that they themselves, along with another partner, were not going to move forward alone. And then lo and behold, the 2017 legislation came out. They looked into Opportunity Zone and Opportunity Zone funds, and it's been a bit of a process since then, but they received significant commitments and interest in the deal. And I think that we're going to be seeing more and more of these type of deals in which the Opportunity Zone funds themselves are going to provide the financing gap. Now, we've also done deals in which the project just happened to be in an Opportunity Zone, so they enjoyed the reduced application fee. And we have lately submitted a deal in the Southeast, which is, I think, pretty unique in that it has a combination of LIHTC and Opportunity Zone funds, a combination that's very difficult, in my opinion, to syndicate to a third party. And this is a deal in which the sponsors have a very deep pocket. They have the need for both the tax credit benefits and the Opportunity Zone benefits, so the sponsor is retaining both and is making the deal work. So again, this is an example of a deal that I don't think would have gone forward, certainly not as an affordable deal without the component of the Opportunity Zone fund. So that's kind of the touches. Let's talk a little bit about this Washington, D.C. deal. Again, I went through this at the Midwest Lenders Conference, and we'll go through this fairly quickly, and we'll entertain some questions afterwards. So, summary of the deal, this is located about 6 miles east of downtown D.C. It's in a rejustification area. This is an area in which very few market rate projects are located. There's a number of LIHTC deals, Section 8 deals, but not market rate. It is part of a planned use development area that was very successful from the standpoint of condominium development, charter schools, some commercial space, and the market rate multifamily was the next component. What's a little unique here is that we underwrote the deal to workforce housing. Now, we've been talking about here what is the definition of workforce housing. In this case, it was rents set at 80% of the DC metro area AMI. So it was still at a fairly high level, but rents were highly discounted from where true market rents are in the metro area. This area also received a real estate tax exemption, 30 years from the district, and total deal of $65 million, $50 million loan, and $15 million of equity. Where we're at with the process is that we have a commitment from HUD, and we have a preliminary closing date set, so it's moving along very nicely. And the timing of the requirements of the Opportunity Zone and the timing of closing on the HUD loan is going to work out beautifully. So we're in good shape there. Mortgage credit review. That was, in the early stages of the Opportunity Zone funds, a bit of the key on how we're going to approach it. If we were going to approach it like a LIHTC deal, or approach it just as a straight market rate deal. So this is probably a pretty good example, and a simplistic one, I would say, of an Opportunity Zone fund deal in which we had two main partners. We had the developer who was originally involved with the transaction, arranged the PUD, was a significant developer within the PUD, and they were in for 15% of the deal. The Opportunity Zone Fund came in at 85%. Again, it was a single individual who had significant capital gains as part of their activities, and we had a sponsor of the Opportunity Zone Fund, which was, I'll call him the syndicator, and much of the responsibilities of the Opportunity Zone Fund and the management was delegated to this sponsor. So that drove our decisions here on how we approached it. So let me go back to the slide. So the things that we really focused on was who was contributing the equity. So again, we had 15% coming in from the developer, in which was really sunk costs that they already had into the deal that was staying in. And then 85% of it was coming in from the Opportunity Zone. What's interesting here is that very early on, the Opportunity Zone Fund took a look at the deal. There was a land loan that was significant. They did a expedited underwriting, and they decided that they wanted to step in and be the lender on the land loan. So they took a bank out and stepped in to be the lender. So they were, which gave, as the underwriter of the transaction, it gave us a lot of comfort that they've already reviewed the real estate. They were all in on the deal, and it was one of those criterias we always struggled with on where, when we bring in a third party, what their commitment is to the transaction, and this told us that they were fully committed. But we didn't stop there. So who was in control? The developer sponsor was in control of day-to-day operations, but the sponsor of the Opportunity Zone Fund, they were the major decision maker when it came to a sale or refinance, which would not surprise anyone. The passive investor, as I mentioned, delegated almost all their responsibilities to the Opportunity Zone Fund sponsor. So what was our review, our mortgage credit review? We did 25/30s on everybody because there's the sponsor of the Opportunity Zone Fund, the passive investor, they had no experience with HUD, so we wanted to make sure that they were in good stead with HUD, and we had no issues there. We did do a limited financial credit review on the individuals behind the developer sponsor and the Opportunity Zone Fund sponsor. The wherewithal behind the passive investor was significant, so we had no issues there. We concluded on Section 50 signatories to be the Opportunity Zone Fund sponsor and the developer sponsor. We did not ask the passive investor to sign the Section 50. So, benefits of the Opportunity Zone structure. Key item here is that the Opportunity Zone funds are not going to transform a bad deal into a good one. It's only going to provide the financing gap. It's going to give you an additional layer of real estate review on the transaction, which is helpful. And again, on the equity, it's going to provide that financing gap, but also given the deep pockets we have here, it's going to provide some additional support, as you do with a LIHTC deal, where you've got a deep pocket sponsor who's going to be able to come in and help with any developer development overruns. And also, given the fact that tax incentives are driving this investment, it's going to change the equity dynamics a bit. Now, in this case, it did not, and I think you'll find with a lot of Opportunity Zone funds out there, they're going to be mission-driven. This was a hybrid of that in which they did want to get involved with affordable and workforce housing. But as we went through the process, it was clear to me that they were looking for a market rate return on their equity. But I think, again, given the tax incentives, you'll have more flexibility here. So, key takeaways: additional equity. Obviously, that's big, especially in this market. As I mentioned, the equity economics, would it be ROE or other metrics, are going to be strongly dependent on tax incentives, so that can be very helpful. I mentioned passive investor benefit. The financial wherewithal that many of these third-party funds bring in is pretty significant, and it does assist, especially on these large deals, to make sure that the financing gap is covered. And then understanding the HUD process, I put that in there because, again, we're talking about a third party, someone who doesn't understand the HUD process, and I think what you'll find is that you got to jump all over it. You got to make sure that they are comfortable with the HUD process, communicate with them constantly, make sure they're on weekly calls, at least weekly calls, so they can understand the process. A couple of additional things I'll add is make sure that you have a detailed letter of intent, just like you do on a LIHTC deal. The way the rules work, there's certain timing considerations opportunity funds have to adhere to enjoy the benefits. Make sure you have that LOI where you have that commitment, you understand what the timing is, and you have their sign-off that they're going to be able to meet that timing. And then the final thing is, what we're learning on this case study, is I was originally concerned with the complexity of the LLC agreement, the borrower agreement. And in reality, it really can be as simple as what you'll see on a market rate deal. There'll be very little difference. So we were pleased about that, and I think it bodes well for the simplicity of the program. That's all I had. Any questions? Yes, sir. It's all front-loaded. Yep. It was not like a LIHTC execution at all. It was all front-loaded. Yep. we did not proceed with the project until the funds were raised. That was the purpose of the LOI. They showed us, in this case, we had a land loan, and they were going to roll that into the investment. But, so we had almost $10 million already locked up. But that's the one key thing I think you need to take into account is I would not advance the ball too far until the fund itself is organized and you're comfortable that it's funded. Yes?
So on an opportunity zone, I have a market rate deal, for instance, doesn't need the tax credit. They just want to use the lower fee. And that's perfectly fine, right?
Yes.
As long as you just prove that it's in an opportunity zone.
Right. It's perfectly fine. Yep. Okay, well, thank you very much. I think we go to a break.